Welcome to the Bucket Plan on Demand, a podcast for financial advisors based on the best-selling book and process that simplifies financial planning. Hear from skilled industry professionals and special guests each episode that will help perfect your approach with clients and your results.
Good morning, everybody, and welcome to another fantastic edition of our Coffee Break with C2P. Very excited about our topic and our guests. It's been an interesting year, to say the least. It feels like the first 4.5 months we've ran a marathon only to find ourselves back at the start line. But I guess that's better than where we started earlier in the year. So we're going to talk about just the market volatility, looking at it obviously through an investment lens, both what has happened and what we see happening maybe into the future, using a little bit of our prognostication skills to see maybe what we can see coming up as well. Joining me today as our guest baristas, first is Stoyan, our very own Stoyan Petev. He is the Senior Vice President here of Advanced Markets at C2P, where he leads our in-house life insurance platform and also supports advisors with expertise in both investment sales and advanced planning. He has nearly 3 decades of experience. He has worked as an advisor, distributor, research analyst, consultant, and specializes in risk management, holistic financial planning, and product development. So thanks for joining us this morning, Stoyan.
Always a pleasure.
And also we have with us Mark Peterson. Now, Mark is the director of BlackRock's Market and Portfolio Insights team. He brings over 25 years of industry experience to his work in investment strategy and advisor education. He is the author of the widely followed Student of the Market publication, helping financial professionals translate complex market trends into actionable insights. Prior to joining BlackRock, Mark held leadership roles at Deutsche Bank and worked on the floor of the Board of Trade and Chicago Mercantile Exchange. Thus, probably our bond conversation to start off today. So thanks, Mark, for joining us as well.
Yeah, thanks for having me.
All right, Mark, I'd like to tee it up with you first, if you don't mind. So how does BlackRock currently view the drivers behind recent market volatility, and maybe how, if at all, does it differ from maybe some past market cycles we've seen?
Yeah, I think a couple things that are driving the volatility. You really saw the economy slowing heading into 2025. And then you add in policy uncertainty, mainly tariffs, but some other areas as well, really drove the volatility. Concerns that you were going to get a slower economy and maybe another dose of inflation. Really, those two pillars, I think, are really the keys. If you look at the last couple of years, stocks have been up 2 years in a row, which has only happened 5 times in the last 100 years of investing history. And I think that was built on the idea that the economy was going to avoid a recession and the Federal Reserve was going to be able to lower short-term interest rates because inflation's coming down. So I think when you ever see either of those pillars challenged, the market seems to struggle. And what we saw in the first part of this year with the concerns about tariffs was that uncertainty leading to a slowing economy, and that tariffs actually might add to the inflation picture, right, in the second half of the year. So really you have both pillars under attack in that first part of the year. And you saw some wild swings in the market. We were down 10% in 2 days in the first week of April. Then we rebounded and we were up 9.5% on April 9th. And this is a pattern we always see historically with volatility, is the best and worst days sit right on top of each other. They're not all bad days, right? I think we always think that there are always going to be bad days if the market's struggling, but you get some of the best days worked in to those, and they live in the same neighborhood. So the last thing you want to do is something drastic with your portfolio, because you miss some of those best days on the other side, and that can cause a serious challenge to your outcome. So, for us, when we look back historically, there's always a different reason for the volatility, right? Think of the last handful of really volatile periods we had was 2022. We had the Federal Reserve raising short-term interest rates. We had inflation at 9%. Or 2020, of course, was the pandemic and concerns, right, shutting down the economy, certainly pretty unprecedented. And even dating back to 2008, the global financial crisis, right, and the housing bubble bursting, there are always different reasons for that volatility, but it always comes back to that economy, right? Is what is the impact going to be to the economy? And I think when we look at it, when the market's jumping around day to day, week to week, month to month, it's the market concerned about with where the economy is headed. It's really that connection, because that's going to translate to company earnings, company profits, and eventually company dividends. And that's what impacts a stock price and the overall stock market. So I think whenever you see these bouts of volatility, understand the reasons are always a little bit different, right? It's the old history doesn't repeat, but it often rhymes. It's the market trying to digest where the economy's headed. And that uncertainty is driving that volatility. So I think that's always something to keep an eye on. If you know the market's jumping around, it's probably concerned with where we're headed as an economy.
I know the stock market tends to get, all the headlines, right? Especially the S&P 500. That seems to be what everyone's most concerned about. However, looking at and kind of our dovetailing from our conversation right before we got started here, like it feels like the fixed income and credit markets have been a little bit more concerning maybe than the stock market. I think the stock market's just moving on news, it seems like, but the credit markets have been behaving a little oddly lately. Do you want to kind of maybe talk about how maybe that's a little bit different from maybe some previous cycles, if there's some warning signs there in the credit markets?
Yeah, certainly. We touched on it before we began the call here that we've seen interest rates come up here, especially in the last couple of weeks, and a little bit concerning from the standpoint that you'd like to see interest rates drift a little bit lower, right? Especially the cost of the overall debt for the U.S. government is tied right to those interest rates, cost more to refinance, and the interest on the debt when those interest rates drift higher. Also reflecting maybe there's some concern about that inflation might have some potential to spike in the second half of the year. I think both of those things are part of the concern. And that's really, I think, where the big divide is with a lot of investors that we talk to is what's your expectation for inflation? Very tough to calibrate that given the uncertainty with tariffs, right? How much are tariffs going to impact inflation? How do they come in? Do they come in all at once, or do they trickle in and kind of linger for a while? I think that's really tough to calibrate right now. So that's where I think the bond market is right now, where we've seen interest rates drift back. But really, if you look at the bond market since October of 2022, that was the first time since 2007, so almost 15 years, where interest rates got above 4% on the 10-year U.S. Treasury bond. And it's bounced between 3 and 5%, right around that 4% since that October of 2022 time period. So I think this is another piece of that story where you just see it bounce and range around those levels. But there's overall pressure because the amount of debt that we need to finance here as a country. There just seems to be overall pressure on driving interest rates higher because we need to find somebody to buy our bonds. And that just puts pressure on interest rates. It's almost the opposite in the stock market, where we have fewer companies going public, right? We have more stock buybacks. So you have less supply on the stock market side. So there's pressure driving stock prices higher. The opposite is true in the bond world, right? Where you have a lot of debt, you need to refinance. Somebody's got to buy those at various interest rate levels, and that puts a lot of pressure on interest rates. So I think that's the dynamic that we see playing out. But I touched it earlier. It's probably not a terrible time to put money to work on the bond side, because you're getting income adjusted for inflation and inflation expectations. So think about if you're getting 4.5 or more on a bond, and you adjust for if your inflation expectations 2.5, 3%, right? Or even if it's 3.5%, that's still a positive income or interest rate above inflation. And we haven't seen that attractive of a really what they call a real yield adjusted for inflation in 10 plus years. So I think we're really fighting with that dynamic where, bonds income start to look attractive at these levels. But overall, we'd like to see interest rates come down just because it does bear a burden on the economy.
Yeah, I mean, obviously you mentioned the debt service, and I think most people know that obviously the debt service is now, the interest on the debt has now surpassed defense spending as kind of that third largest expenditure. I think there's been some concern for some time that we were going to get into a long cycle of rising rising rates on bonds because of the debt service. Do you think we're starting now that, the kind of getting to that phase, or is that still maybe a ways off and you could see rates coming back down again? I mean, I think there's a concern that we might be, kind of getting into a long cycle rather than these short cycles we've seen in the past, and that the era of cheap money, so to speak, is ended forever.
Yeah, the tagline everybody likes to use is higher for longer, right?
Yeah.
And I think that is true. I think we're in this range, though. I really do think this is the range bound world that we're living in with interest rates, where certainly the higher end of that range is probably higher than we're comfortable with and higher than we've seen probably since before the global financial crisis on the interest rate side. So I think that is our new reality. I don't think there's necessarily another big leg up, just because I think inflation has come down. Right, we were talking 9+% inflation back in June of 2022, and the headline inflation number recently was 2.3%, very quietly, the lowest level that we saw since February 2021. So that number's come down. Right, it's certainly not perfect. Still means prices are going up. Don't get me wrong there. Right, but it has come down, and everybody will want to take credit for it. But it's just what inflation does in a properly functioning economy. So, there's still pieces that need to come down with that inflation story. The housing market is the biggest piece of that inflation calculation. This is my inflation soapbox here, by the way. Where I get geeky on inflation makes me hit at all the cocktail parties again. But 35% of the inflation calculations, that housing piece, that's still 4% inflation within the calculation. So that is an area that's coming down. It's just not coming down as fast as we'd hope. So I think bonds and interest rates are going to be in this range bound. Even when we see interest rates start to come down again, that pressure with all the debt and everything we need to refinance just seems to put pressure whenever we get a whiff of decent economic news, right? It seems to drive interest rates higher because of that supply demand dynamic that's a bit out of whack.
It's fascinating how we all started to talk about interest rates. My favorite topic outside life insurance.
I mean, we always talk about the stock market. It's all the headlines. Stoyan, I wanted to just, kind of dovetail with you now on what Mark just said. And I know you work obviously with our advisors, with clients directly. One of the main questions we often get is like, is it time to do something different, right? Like, should I be making a shift? Should I be changing my strategy? How do you, kind of respond to that? And especially in volatile times like now, where people might be maybe overreacting to the news every day.
Well, in times like these, you have to always validate their emotions, right? When people call you with those types of questions, you have to validate their emotions. You have to lead with empathy and acknowledge their concerns, because uncertainty leads to anxiety, and people need to be heard first before they take your advice. So you have to say something like, "This is a very reasonable concern, and it's completely normal to feel that way in periods like this." And maybe take an opportunity, like the client is presenting, to maybe update their volatility tolerance analysis. Maybe they weren't as risk averse as they said they were. So things like that are your opportunity to kind of re-engage the conversation, reframe it around their goals within their bucket plan. Volatility is going to be with financial markets all the time. That's why you're earning a historically higher rate of return than risk-free rates in cash, because you're taking that additional risk for the opportunity to earn that excess return, and also use that opportunity to educate them. Educate them what's happening in the markets, educate them a little bit around tariffs, why the recent volatility, what's going on with from an economic perspective, and just share some statistics with them. For example, if you look over the last 75 years, 91% of the times you've had a 5% pullback in the market. 55% of the time you've had, almost half the time you've had at least 10% or more of pullbacks. Almost a third of the time you've had at least 15, and almost 1 in 5 years you have 20% or more pullbacks. And it's if you in a kind of talk to them about the staying power of being invested and having that soon bucket maybe to cushion some of that volatility that they have in their portfolios. But yeah, interest rates are presenting some very interesting opportunities for us in the soon bucket. Mark talked a little bit about that with respect to bonds. Annuities, you see the rates with annuities right now on the rise as well. Caps on the indexed annuities are on the rise. Caps on buffered ETFs are also on the rise. So use this as an opportunity to educate. Do we have enough money in the soon bucket? Do we have enough buffer in our portfolios to take advantage of opportunities going forward?
You mentioned kind of the risk premium conversation, right? Like, one of the downsides I always thought of the cheap money era was that, when you're getting zero basically on cash and 2% on bonds and 9 or 10% in the market, it effectively forces you into the equity markets. I mean, the risk premium is just too great to ignore. That equation seems to have changed, and I know there's a lot of economists that I've seen and read where they think that is kind of flipped now. Where if you're in a 4 or 5% range on bonds and markets 6-7%, does that change the equation kind of longer term in terms of taking on that additional risk in the equity markets?
Of course it does. Yes, it now you have actually an alternative to 0% cash. And that alternative is actually not looking bad. I mean, if you look at, for example, guaranteed annuities, which you can use as an alternative to bonds, you can earn over 5% on a 5 or 6 year locked interest rate. So that is not bad. When you look at it from a historical perspective, that is not bad. And I've always said that bonds are contracts and stocks are stories. And stocks will fluctuate based on whatever that story is today, whether it's going to be inflation, whether it's going to be tariffs, whether it's going to be GDP numbers, whether it's going to be earnings. There are always
I think the stock market's just doing it on tweets and X's
right. Yeah.
and truths like that. It's just moving on that now.
And at the same time, bonds trade on contracts, so you have a contractual obligation to pay that interest rate, and you have a contractual obligation to return that money at the end of the investment period. So one of those two is always going to be right. And I have my convictions, and I think we talked a little bit about that before we started on the call. But of course, that's why we have markets, right? Markets, you have varying opinions, and those varying opinions clash on a daily basis, where people think interest rates are going to go, where people think tariffs are going to go, where people think taxes are going to go, or earnings are going to go.
There seems to be a little bit, and obviously the president has come out and said this as well, like the Fed's moving very slowly, right? Like obviously the CPI data that just came in kind of indicates that inflation is cooler than maybe some people expected, especially given tariffs. But yet the Fed is really, not willing to make a rate change at this point. Do you think that's, the Fed's not looking at the data the same way? Or are they looking at something else in the future? Is there just a disconnect kind of between the Fed and the numbers coming in right now? I guess maybe, Mark, if you can just unpack of maybe what the Fed might be looking at from a interest rate standpoint.
Yeah, I think the Fed, really thinking that a lot of the tariff news is not yet in that inflation number, right? That, you maybe have small pieces, but most of it is still in front of us, right? What that impact will be. And I think that's just really tough to calibrate. Again, what is the impact going to be, how it's going to flow through. And that's why I think they're being a little cautious here, right? In bringing rates down. You look at the market, and the market's pricing in maybe 2 rate cuts by year end. That kind of feels about right to us, right? I think they'd like to bring rates down. Think about, again, we've been right 4.5, 4.25, 4.5 this year for a while. So, I think they'd like to bring it down, get those costs of refinancing the debt. They'd never say that, right? But I think that's part of the equation, get that down. So, but I think it's the market struggling with what that inflation expectation is. They want to be conservative. I think if you look historically with bouts of severe inflation, it tends not to be one wave. It tends to be a couple waves. And I think that's where the concern is. They don't want that second wave of inflation to come back into the picture. So that's what they're fighting. But hopefully, I think, we talked about those two pillars of avoid a recession and you get a Fed rate cut, that's a really good combination for portfolios. When we look back historically, stocks average 21% in that environment and bonds average 7. Granted, that's some higher interest rate periods included in there. But if you get back to that, okay, we're going to stay out of the recession, but we are going to get those Fed rate cuts, I think portfolios, especially stocks, can get back on track in the second half of the year. Granted, valuations are cheap, so maybe it's more of a market broadening story. But I think that's how it all for us ties together, right? That inflation outlook just so critical right now, but so murky because that tariff story is still, right? We're still trying to get to the other side and get a little bit more certainty overall.
We're gonna try to build on that a little bit. We talked a little bit before we jumped on the call today about the signal that the 10-year Treasury is kind of giving out today at 4.5%. I mean, it's stubbornly going up. So the bond market obviously expects some news with respect to inflation, and maybe that inflation is going to be stickier than people think. We'll see if that's true or not. There's going to be a lull, and we're kind of in the lull period of the price swings from respect to the tariff wars. And a lot of people try to front run some of the tariffs by ordering in advance. So there was a little bit of extra inventory that people built up over the last few months. And as that is working through the economy, my observation from kind of reading and listening to people that are way smarter than I am is that the price fluctuations on the downside right now as a result primarily of that. And then the tariffs, I think Walmart CFO came out this morning and said that they're going to start adjusting prices upward next month. So that's kind of the next phase. And I think when I look at the credit markets, that's kind of what the credit markets are telling me as well, is that maybe the inflation is not as baked in as people think it is.
You're saying basically we haven't seen the effects yet. So
Right.
Caution is warranted.
Yes.
I want to go back to the risk premium conversation again, is that, also we know we've talked about bonds, we talked about equities, but there's also the cash play, right? Where also the yields on cash and money markets and cash-like instruments has also increased. Is there, an advantage to, kind of looking at cash over bonds, or do you think, again, kind of looking at where these things sit in that risk reward spectrum, and then also the liquidity, obviously, that comes from a cash play?
You look back to that October of 2022 when we reset interest rates higher at around 4%. It was a little bit over 4. And you look since that time period, bonds have actually outperformed cash by a fairly healthy amount. But cash has still returned 4.6% over that stretch. And you've had some flexible bond strategies do a little bit better, right? 7+% over that same stretch. So I think this is a nice environment where you have the ability to use both, right? That it's so long that we didn't have cash as an option, right? At least now it's back on the table and as an option. Even though bonds have outperformed over that stretch, I'm sure nobody's too concerned about their decision to invest in cash and get a 4+% return with no volatility in that part of the portfolio. But I think we're at this is a nice sweet spot. We think, again, just because you are getting a nice real income level, right? Inflation adjusted income level above what we've seen in a long time. And that's always a good time to put money to work in bonds and fixed income, right? Where you can get a little bit more return, but having that lever, just having that cash lever back in play again, just talking with folks across country, right? It's just a game changer that we didn't have for so long. You kind of forgot how useful it can be in short periods of time, right? Maybe not for longer stretches, but certainly nice as an option again.
Yeah, and obviously that's also a function of the yield curve, which we've seen short-term yields stays fairly high compared to medium and long-term yield. Do you see the yield curve shifting at all, especially as maybe the Fed does make some rate changes?
Yeah, I think you can see it steepen out a bit, meaning the front probably comes down a little bit. We actually like the shorter end of that yield curve, right? They call it the belly, is kind of the bond word for it, right? But where you're getting a lot of the income that you're getting on the longer end of the curve, but you're doing so without a lot of interest rate risk, right? Which has been a challenge because it's been so volatile at that longer end. So we like, especially right, if you see them lower short-term interest rates, right? That could benefit the belly of the curve because you're getting a little bit more income, but all of a sudden you're also getting a total return benefit as shorter term rates come down. So that's really for us a nice spot to be in this environment if the curve does, right? If we do get those Fed rate cuts here in the second half of the year.
And that usually plays into some of the portfolios that we have on the platform from BlackRock, the multi-asset income portfolios. And when you look at risk premia on over and above the risk-free rate, um, and you tie that to the economic activity, um, that's why I like those multi-asset income portfolios as much, because I don't think anybody expects a meaningful recession to happen over the next year to 2 years. And that's where you're going to extract the benefit of having preferred stock, of benefit of having income generated options like master limited partnerships in those portfolios, like maybe a little bit high yield play, high dividend plays. These are the things that actually are going to work in an environment when you have a robust economic activity. Yeah, we may have a little bit of inflation in the short term, but things are lining up pretty solidly for the second half of the year going into the next year from an economic activity standpoint. And that's why I kind of like that the risk premia that I'm getting on the multi-asset income portfolios.
Well, we are nearing the end of time. And any final thoughts from you, Mark, or you, Stoyan? Any kind of words just as we wrap up?
Yeah, I think for us, the diversification story is back, right? I think you're seeing that play out this year. We haven't touched it too much, but international's up, right? A bunch. And you see that often when U.S. stocks can struggle. You actually see some of those international markets step to the plate and add value again. It's been a while since we can say that. Also, some of those alternative strategies have done really well. So those things beyond just stocks and bonds, whether it's an asset class or a strategy within stocks and bonds, have delivered a lot in this environment, especially because we've had some windows in time where stocks and bonds have sold off together. Just throw one more stat at you. We had 14 months in a row when stocks lost money, bonds lost money as well. That's never happened in the history of investing. The longest previous streak was 6 months, believe it or not, back in 1994. Luckily, that ended in the first quarter of this year, but it's still the dynamic where you've got stocks and bonds maybe moving too often together in this environment. So for us, embracing that diversification, having that plan, like I know all you do, have a volatility plan, right? Have a bear market plan with folks. That's the best way to get in front of these volatile periods. Because if you wait for their emotions to get revved up, right, it's probably too late to do anything really effective in the portfolio.
And be disciplined, right? Stick to the bucket plan. Have that non-correlated asset inside the soon bucket that maybe you can use for opportunities when they present themselves. When you have those big market drawdowns, maybe have that opportunity cash sitting in there to kind of take advantage of those market swings, and use some of those non-correlated assets that we've talked about, like annuities, like traditional life insurance, things that have the mortality kicker to them, as opposed to just a function of what's going on in the marketplace. And we just reach out to us. I mean, we can always discuss some of these opportunities, whether it's going to be alternative assets, whether it's going to be non-correlated assets, because those assets that are non-correlated to what's going on, to what Mark alluded to over that 14-month period, when you had both bonds and stock losing money, those non-correlated assets are actually the anchor to your portfolio. So use them judiciously, and you guys have the framework within the bucket plan to do that.
We're a little over time, so just want to say thank you all for joining us for a coffee break today. Stoyan, Mark, thank you so much for being our guest baristas. So thank you all. Have a great finish to your week, and see you next Thursday.
Thanks for tuning in to the Bucket Plan on Demand, brought to you by C2P, an organization whose purpose is to educate, train, grow, and support holistic financial advisors so families can achieve true prosperity. Subscribe today for the latest episodes and insights. Visit c2penterprises.com to learn how we can help support and enhance your advisory business. At the time of delivery and any subsequent publishing, information was deemed reliable but is subject to change by the time of listening or viewing. The contents of this piece include options and projections of C2P, are subject to change, and are for informational purposes only. The information provided in this presentation is not intended to be individual investment, tax, or legal advice.